Hello, everyone. Hey, so firstly, thank you for the introduction. For those of you who are not aware about Zerodha, Zerodha is one of India's leading stockbrokers. We started operations in 2010, and initially our play was around pricing. The brokers of that time, they used to charge a percentage-based fees. So the higher would be your trading volume, the higher would be the brokerage cost, since it's charged in percentage. So we are the first ones to introduce a concept where we charge a flat fee of 20 rupees or 0.01% at that time, irrespective of the volume you're trading, right? So this gave us a lot of traction early on because the incumbents of that time, their charges would be quite exorbitant compared to ours, right? So initially, the main problem was to convince people that we are a legit business, right? And I was just telling sir that it took us about 9 years to accumulate 10 lakh clients. And considering that the stock market was a shallow place, I think 3 years ago, there were only about 2.5 crore unique demat accounts. We really didn't know where to go from there, right? We kind of felt like a big fish in a small pond. But nothing could have been as surprising as the last 3 years. We saw a tremendous interest in the markets, and we saw an influx of young people coming to the markets and trying to figure out how to start their financial journey, right? So in these 3 years, we accumulated about 1 crore 20 lakh clients, and most of them being in the age group of 21 to 28, right? So it's been one of our endeavors to have interactions like these where we can talk about personal finance and hopefully give you guys some basic tools that'll help you embark on your financial journey. So firstly, why learn about personal finance? No matter what stream of education you all come from and whatever careers you all adopt, one thing is for certain is we all will need to play the role of a fund manager in our lives, right? Either you'll be managing your funds or your family's funds. So it becomes very important that we are savvy when it comes to money. We know how to invest and grow our finances, right? And the number one goal is to chart out a path to financial security and independence. We all are putting ourselves through education, trying to skill ourselves because we want to ensure we get a good job and there's a financial outcome to it, right? We all want to be financially secure and hopefully down the line be financially independent where we are not relying on our job later in life. Personal finance will also help you make better informed decisions. It will help you avoid debt and financial pitfalls. It will help you prepare for life's uncertainties. One thing is for certain is at some point we all will be hit with a financial crisis, and only if we have thought about it beforehand and prepared for it will we be able to tackle them efficiently, right? And hence it will allow us to go through our financial journey in a less stressed and more empowered and controlled manner. So we'll get into the building blocks of personal finance. The first pillar that we'll look at is to build an emergency corpus for yourself. The second aspect would be to get life and health insurance. These two topics basically mitigate risk. Once you have taken care of these, then you can look to invest whatever surplus you have into equity and other assets. And ensure we have a basic asset allocation in place, right? Putting all your eggs in one basket is definitely not a good idea. And lastly, don't forget to live. Personal finance is just not about saving money, it's also about living a good quality life. You want to make sure that you have those experiences that you want, and it'll definitely help you to achieve some of those milestones, and it's best to factor in those kind of experiences that you want into your personal finance plan. Firstly, why do we need to invest? We need to invest because money loses its purchasing power over time, right? We've all had this experience where we have seen things generally get more expensive. In my time, a cup of coffee in Coffee Day would cost around 35-50 rupees, right? In your time, it was about tropical iceberg was like 35 rupees, right? And currently, as time has moved on, it's about 250 rupees, right? So money you have saved today will be worth far lesser in the future. So we need our money to grow as well. So Milton Friedman, who's an award-winning economist, he said that inflation is caused by too much money chasing after too few goods. Whenever there's too much cash available, that tends to leads to a stress on goods and services, right? Like for example, during the COVID time, everyone were afraid that this could lead to a full-blown recession, right? We saw unprecedented lockdowns. The global economy had pretty much come to a halt, right? So governments all across the world, they added stimulus packages to the economies. We saw central banks reduce interest rates, all in a bid to keep the economy flush with cash, make sure there is money in circulation, right? Just to make sure there's some economic activity happening. Now, when there's a lot of cash available, then it leads to a stress on goods and services, right? Because goods and services are finite. Once there's excessive demand for them, then generally you'll see an increase in price. Like for example, if you had access to a cheap loan, you'd probably utilize that loan to go buy some goods or service, right? If you are a company, you'd utilize it to maybe scale your operations, right? So once goods and services are flying off the shelf, and those goods and services being limited, there'll generally be an increase in price. So if we see the graph here, India's 12th month inflation trend, as of April of 21, inflation was at 4.23%, and this grew to 7.8% in April of 2022. And India's average inflation rate over the past decade has been over 6%, right? So money will lose its purchasing value by 6% every year. So we need to ensure that our money is able to grow at a minimum of 6% and much beyond that, and give us good outsized returns. So if inflation is kind of eroding the value of your money, what works in your favor is compounding. I know these are all very basic concepts, but too few of us actually utilize this and add this to our financial plans, right? So Albert Einstein had mentioned compounding as one of the wonders of the world. Compounding doesn't rely on earning big returns, merely good returns sustained uninterrupted for the longest period of time, right? So here the emphasis is on investing regularly for the longest period of time. I'm sure you all would have heard of Warren Buffett, right? He's widely regarded as one of the greatest investors of our times. There are probably thousands of books written on his performance, which is awesome, because he's been his compounding rate is about 22%. But what is not mentioned enough is the amount of time he spent in the market. If he's worth about $84.5 billion today, $84.2 billion he made only after his 50th birthday, right? So time has played an extremely crucial role in his wealth accumulation journey. On the other hand, we have someone like Jim Simmons, who runs Renaissance Technologies. He's been compounding at a rate of 66%, which is unheard of, right? It is absolutely phenomenal to sustain that high level of performance. But his fund in comparison is worth around $20 billion, right? Even though his performance is so extraordinary. And the reason for this is Jim started his fund in his 50s, right? So more than performance, time plays the most crucial role when it comes to compounding, right? So just to emphasize my point, I would like to open a simple compound interest calculator. And I would advise you guys, whenever you're making a financial plan, to try to come up with some kind of a number so that you can work towards it. So on this calculator, let me add an initial investment amount of 1 lakh rupees. Monthly contribution to this, let's keep it at 10,000. Length of time in years, we'll add as 10 years. Estimated interest rates, market gives anywhere between 15 to 25% traditionally, so let's give the lower bit and say 15% and calculate. So if you are diligently invested 10,000 rupees every month for 10 years, you would have a corpus of 28,41,000. Let's ignore the dollar sign, right? That would be 28,41,000. Not too exciting, but for an amount of 10,000 rupees, I suppose it's okay, right? Let's increase the time, right? Instead of 10 years, let me increase this to 15 and then say calculate. Now in 15 years, you would have accumulated a corpus of 65,23,000. Now the interesting bit here is that it took you 10 years to get to 28 lakhs, but the next 5 years yielded 37 lakhs, right? So you more than doubled your investment in half of the period of time, right? So this is how compounding works, where initially it is like watching grass grow, but once when you reach a certain value, then it kind of explodes and gives you significant returns, right? Now let me increase time a little bit more, right? Maybe it's a bit too much for you guys. I'm just increasing it to 20. But what we all don't realize is, I know because the way we are wired, we kind of like, we are able to just think of the immediate future, right? We are able to see 3 years, maximum 5 years, we can have a plan, right? But can't really imagine yourself 20 years from now. But 20 years from now, you'll still be around, right? And probably at that time, you'll require a lot more money than you do today. So it's always advisable to think in the long term as well. So added 20 years here, and I'll say calculate. Right, so we really see the acceleration pick up. It took you 15 years to get to 65 lakhs, but just waiting that extra 5 years has just about doubled your money, right? You have gone from 65 lakhs to 1 crore 40 lakhs. So that's basically how compounding works. We want to ensure that whatever we are doing in life, we have a plan in place where we are looking to use this to grow our wealth. So the key is to start early, even if it's like with a humble amount. Invest on a regular basis, and longer the time frame you give it, the higher will be the acceleration. So coming back to our building blocks of personal finance, the first building block is to create an emergency corpus for yourself. Now what usually happens to all of us when we start working is we immediately, as soon as you get your first job, you start upgrading your lifestyle, right? You'll go buy the phone you want, you'll buy the laptop, maybe you buy a new two-wheeler or four-wheeler, you take up more responsibilities at home, and you kind of take on a lot more EMIs on yourself, right? And then when there's a sudden emergency, you're caught completely off balance, right? So the idea first is to build an emergency corpus for yourself. Now, pay yourself first is basically a mindset where normally, as I said, once you start making money, you are immediately thinking about how to spend it, what all expenses are there that I need to tackle. But with pay yourself first, the idea is to prioritize your saving, where instead of income minus expenses equal to saving, it should be income minus saving equal to expenses, where as soon as money comes in, first you feed your investment account and then you utilize whatever is remaining for your expenses, right? It could be a very basic amount to begin with, but the idea is to build that practice where you are saving first, right? Now, your rainy day fund, we typically recommend having 6 months of your living expenses tucked away. There's no real hard rule. Everyone's financial behavior is different, but 6 months is a pretty good start. Now, the whole idea of having this fund is, especially early on, is it'll help you, in case you're transitioning jobs or if you've been laid off, or if there's some other emergencies that you need to look at, right? One thing I would like to say is not to utilize your emergency corpus for lifestyle purposes and just keep it for emergencies. And even if you do use it, ensure that you replenish this back on priority, right? And this rainy day fund you can keep in fixed deposits or liquid funds. We'll get into this a little later on. The next pillar is insurance. Life or term insurance, I'm sure you guys are not really thinking about it, but as you grow older and you have more people depending on you, this becomes the most responsible thing to do, right? Because in case something happens to you, at least people you love, they are well taken care of financially, right? So we need to have this in place. Medical insurance, medical bills are probably the #1 killer for middle class financial wealth, right? Medical bills can literally run to tens of lakhs. So usually when you guys join a company, they'll give you a medical insurance under their corporate group cover, but usually it will not be enough, and it's always advisable to get a private insurance in place. The reason for this is you will not be relying on your job anymore for your insurance, right? Because tomorrow if you lose the job, you'll also lose your insurance, right? And secondly, if you take a private insurance early on while you're young and healthy, the premiums tend to be far lower than suppose if you start taking insurance privately, in your 30s or 40s. So it's always advisable to have a private medical insurance running in parallel to your corporate insurance, right? And I have personal experience with this, because I remember long back, when I was working in some other company, my insurance cover was about 3 lakh rupees, and being a young guy, I thought that's sufficient. But then someone from my family fell sick, required extensive hospitalization, and that came up to about 21 lakhs, right? So that I've learned from my own experience, to make sure that, I tell you guys to get a private insurance as well. Now, I've also added a screenshot here of Ditto. How many of you read Fin Shots? or have heard of FinShots? All right, I see a few hands. Awesome. So for those of you who don't know, FinShots is a daily newsletter. It talks about current affairs, about the economy, about the startup ecosystem, etc. Now, the same team who created FinShots founded this company called Ditto, and within 2-3 years, they've become among the top insurance advisors in the country. So if you guys want to know more about insurance, you can definitely check them out. They have quite a few podcasts and blogs. And what I like about these guys is they don't kind of do any kind of push sales, and they don't kind of nudge you to certain policies, but they kind of give you genuine advice. So you can definitely check them out. So once you have your rainy day fund in place and you have insurance in place, now we can look to invest whatever surplus we have into equity and other assets, right? Now, the first asset class we'll look at is equity. Equity is nothing but being a shareholder in a company. So the whole idea is that if the value of the company increases, the value of your shares increase, and you can sell it in the marketplace to make a handsome profit, right? Now, traditionally IPOs, or initial public offering, we all know what IPOs are, right? So IPOs have been a good event that usually brings in a lot of first-time investors, right? Whenever there's IPO, you see new people opening demat accounts for the first time. Now, the reason for this is usually there's a lot of excitement whenever a company is listing, and there's a lot of buzz about the company. And generally, the public sees this as an opportunity to make quick profits, when the company lists. That happens usually when markets are stable or are doing really well, like right now where we are at all-time highs. But say 2 years ago, when the markets were sideways, we had companies like Nykaa or Zomato or Paytm, Policy Bazaar, etc., lose 50 to 75% of investor wealth, right? So can't really take IPOs for granted. We need to do our own research. Every company, when it's listing, issues what is called as a red herring prospectus, which details the operations of the company and their product information management, etc. So if you're looking to invest in IPO, it's more advisable to go through that document. If you're not someone who's analytical or doesn't want to get into it, I'm sure you'll find a lot of helpful blogs, etc. Now, the next word we look at is buying stocks. About 15-20 years ago, if you wanted to buy stocks, you had to visit your local stockbroker, open an account, and then call your broker whenever you wanted to buy or sell a stock, right? But now, with technology, with smartphones, it's extremely easy, right? One thing I wanted to mention about buying stocks is you need to be comfortable with uncertainty, right? You're never going to know too much about any particular company. Like, for example, I am from Zerodha. I know how we did last year, but even I don't know what's going to happen next year, right? And as an insider, if I don't know what's going to happen, how will you, right? So it's always advisable that when you're looking at stocks, you buy an array of stocks, right? You kind of spread your risk by diversifying and buying different stocks, maybe from large cap, mid cap, small cap, and spread across different sectors, right? Now, I was just talking to Mohanji about small case, so maybe we'll show them small case, right? Because I think that if you're someone, normally if you really want to get into studying stocks and what to buy, what not to buy, Usually you'll have to study fundamental analysis and technical analysis just to give you a basic idea of how to value a stock and whether stock is well priced, right? So if you're someone, just in the spirit of keeping things easy, I'd like to show a tool called small case. How many of you already know what small case is? All right, not bad, 3 hands, 4 hands, right? So basically small case is a thematic investment platform. Here the focus is on selecting ideas, and each idea will have an underlying basket of stocks which is associated with that idea, right? Like for example, we have like all weather investing. This is a basket of stocks, actually ETFs, which is well diversified between equity, gold and debt, right? Or you have a basket called dividend aristocrats, companies that have consistently been giving increasing dividends, right? Or electric mobility, right? Like we all know, we are transitioning from combustion engines to EVs. So if you think companies related to electric mobility will do well, maybe this is a basket of stocks you can pick up. So it becomes extremely easy where the focus is not on particular stock but on the bigger picture, right? Actually, next we look at investing in mutual funds. You all know what a mutual fund is, right? All right, awesome. So I'll just open up a mutual fund platform. So let's look at this fund called Axis ELSS Tax Saver Fund. Now firstly, ELSS stands for Equity Linked Savings Scheme. These mutual funds provide a double benefit where it gives you the appreciation of the market, and also it allows you to save up to 1,50,000 of taxable income by Section 80C of the income tax, right? So these funds are usually a good way to dip your toes into the market because it has a 3-year lock-in period. Most people come to mutual funds, ELSS funds, to save tax, right? And then they kind of are able to see with their own eyes the kind of growth they have in 3 years, and that kind of initiates them to invest further. So ELSS is definitely a good category of funds to invest in to save tax as well as build wealth. Now every mutual fund platform will typically show you the performance of the mutual fund. It will show you what is the current NAV, which is the unit price of the mutual fund. It will show you what is the CAGR, compound aggregated growth rate, what is the minimum investment required, what is the AUM, exit load if there's any penalty for exiting early, and something called as a expense ratio. How many of you know what an expense ratio is? All right, a few, right? So obviously when you're investing in mutual fund, it can't be for free, right? The fund manager who's managing your fund, he needs to get paid. The asset management company needs to get paid. So they charge in this expense ratio, right? And normally you don't get to see it because it is set off on the NAV, but this is a charge that you will incur whenever you're investing in a mutual fund. Now, primarily there are 2 types of mutual funds, right? You have direct mutual funds and regular mutual funds, right? 2 types. Direct mutual fund is basically whenever you're directly buying from the asset management company without any middleman being in the middle, right? Whereas whenever you're buying mutual fund, say from your bank, a financial institution or advisor, you're typically buying a regular mutual fund which has a middleman in the middle, right? The bank, the institution, they act as this middleman, and they kind of get a distributor commission in the middle, right? And unfortunately most people are not aware, and whenever their bank calls them and pitches to them about mutual fund, without realizing, they kind of go ahead with that. But it can be quite detrimental, this regular mutual fund, because the expense ratio in them will tend to be much higher, right? So as we can see, these are direct mutual fund platforms. Expense ratio is at about 0.78%. Now, if I was to say open money control, same access ELS as tax saver fund, select regular, the expense ratio is 1.54%. Okay? 1.54%, which is almost double of 0.78%, right? And the thing is that this distributor commission is not just charged when you are entering a mutual fund, it is charged for as long as you're vested in the mutual fund. And mutual funds being a sticky, sticky asset where you kind of invest for the long term, this could literally lead to tens of lakhs in distributor commissions, right? So whenever you're investing, Mohanji, are you investing regular or direct? All right. All right, awesome, right? So whenever you do start investing, ensure you invest in direct mutual funds. That will allow you to definitely save a lot on cost, right? And there are about 4,000 different mutual funds to choose from, so it can get quite confusing, but just to keep it simple and effective, what I can recommend is index funds. How many of you know what an index fund is? All right, just a few hands up, right? So we all heard of Nifty 50, right? Right, so Nifty is our premier index. It contains the top 50 companies in the country, all market leaders from different sectors. They are given a weightage and a value is derived out of it, which represents the broader economy, right? Because we are taking into consideration the best companies of the country. So this mutual fund basically mirrors what the index is doing. It has the same 50 companies in the same weightage. So if the index goes up by 10%, even your index fund will also go up by 10% because it contains the same companies in same weightage. Now, I was just telling sir as well that out of every 10 fund managers, only about 2 or 3 will end up beating their country's benchmark in the long term, right? This is historical data what we have, right? So only 2-3 will be able to outperform Nifty, right? So what's even the point of selecting a fund and an X fund manager, because we cannot be certain whether he'll be able to beat Nifty. So maybe it is better to invest in the economy itself, right? You're right, because we don't know if a fund manager will do well, but we can be reasonably more certain that India will do better 10 years from now, right? So, so the whole idea of index fund is to invest broadly, with respect to the markets. And also the expense ratio in these index funds tends to be much lower as well, because you really don't need any active management, right? If the criteria for a company, if a company is removed from Nifty 50, the same company will be removed in your fund and a new company will be added. So I have a quote here from Warren Buffett again, which says, "Our favorite holding period is forever." Now, what we need to understand is time in the market is greater than timing the market, right? We have all heard of, everyone has their own perception of whether something is expensive or not expensive, right? What is expensive today may not be perceived as expensive tomorrow, right? Like for example, when Nifty was at 11,000 about 2 years ago, a lot of people were telling that, it's probably going to fall from there, only to see it rise to 22,000 in the last 2-3 years. So no one really can predict what's going to happen, right? Because there's just way too many variables involved. And as I said, a lot of it is based on perception. Also, there was a study done where if you had, say, invested 1 lakh in 2003, that 1 lakh would be worth 20 lakhs today. On the other hand, say if you had invested 1 lakh and you try to time the market, and say you miss like the 10 trading days, in 20 years, out of 5,000 trading days, you miss just 10 trading days where market moved the most, right? That 1 lakh would have yielded about 9 lakhs. So you would have lost 50 to 60% of possible profit just by missing the top 10 days of the market, right? And these 10 days out of 5,000 trading days, I think 8 of them happened when when the market was moving sideways or there was a lot of pessimism in the air, right? So timing the market is kind of like, is a bit futile. You're going to get it wrong more often. So the whole idea is to buy good assets and keep them for as long as possible. Now we'll also, as I said, we'll need to ensure we have a basic asset allocation strategy in place and not put all our eggs in one basket. The graph above that shows the current investing habits of Indians. 50.7% of Indian households invest in property, 15.5% invest in gold, and 14% invest in bank deposits, right? So equity is at about 4.7%, which is just growing. I was just telling sir that 3 years ago, we had only about 2.5 crore unique demat accounts, and within 3 years that's grown now to 9 crore demat accounts, right? So this is the current investing habit of Indians, and it's usually, we can see a lot of influence of the past on this, right? Because this kind of shows what our elders prefer actually, right? Because like for example, bank deposits, right? Why are bank deposits so high when they provide a paltry return? That's because we all are biased towards assets we have seen do well in our times. Like for example, I have seen equity go from 4,000 to 22,000, so I am biased towards equity. My father, who has seen the real estate boom in Bangalore, he's probably biased towards real estate. So elders could possibly be more biased towards fixed deposits because they've seen that do well in their times, right? Fixed deposits used to give you about 12 to 10% returns a few decades ago, right? But currently with 6 to 7%, doesn't make too much sense to do that, right? Now coming to how we need to invest, typically the younger you are, the more you can invest in equity, which would be about 70%. Again, depends on your risk tolerance, and 30% you can divide it among gold and debt. How many of you know what a debt fund is? All right, a couple of hands. So debt fund is again a mutual fund, but instead of investing in equity, they invest in government bonds, treasury bills, commercial paper, etc., which provide a fixed return and are less risky, right? So we need to ensure around 30% is between gold and debt. Now gold, we all know gold as an asset, right? I mean, India is the largest importer of gold, right? So, but what the government is trying to do is incentivize digital gold. So they issue what is called as a sovereign gold bond, or SGBs. These SGBs give you 2.5% interest per year, and also the appreciation of gold after maturity, and they're tax efficient as well. So they're trying to encourage people to buy digital gold rather than physical gold, and these are a really good asset if you want exposure to gold in your portfolio. Fixed deposits, as I said, maybe you can put your rainy day fund in that. Real estate, typically very expensive, especially when you're starting out, but it's a great asset to own. It's multifaceted. You can live in it, you can rent it, you can build a business around it. In the markets, if you want exposure to real estate, you can look at REITs, REITs, real estate investment trusts. They also function like mutual funds, but instead of investing in equity or gold, they invest in commercial spaces and retail spaces, etc. Right? So that REITs can also be a good investment if you want some exposure to real estate. And the idea is to do 70-30, and as you grow older and you want less volatility in your portfolio, then you could gradually bring equity down and increase gold and bond, right? So in your 20s, it could be 70-30, maybe by the time you're in your 60s, it could be 80 gold and debt and 20 equity. So I have a table here which shows what have been the best performing assets on any given year. 2013, okay, I think I'll just read it out. 2013, large cap stocks did well, giving 9%. 9% for that year was okay because it was like, economic slowdown and all. 2014, we saw, with elections and stuff, we saw small cap giving 63% returns, mid cap giving 54% returns, large cap giving close to 30% returns. Then 2015, quiet year for the markets, we saw corporate bond give 9% returns. 2016, we saw government securities give 15% returns, corporate bonds give 12% returns. 2017, the stock market was back with a bang. You had small cap giving 60% returns, mid cap close to 50%. 2018, gold with 8%, government securities with 8%. 2019, gold with 21%. 2020, gold with 27%. 2021, small cap with 63%, mid cap 40%, etc. Right? So the whole idea of going through this is, I hope you guys can see a trend, right? Something good happens with the markets. You see a big surge in the markets, and then you see a few quiet years where other assets like gold or bonds do very well, right? So every asset has its day under the sun, right? So we need to, this primarily the reason why we need to ensure we have a diversified portfolio is because if it's a quiet year for equity, then bonds and golds will lead the way and you can capitalize on their performance as well. Right, so what do you guys think is the best asset to invest in? Is it gold? Is it equity? Is it debt? Or having a mix of them? Right, so this is typically a question I ask, which is actually a trick question because I'm going to completely switch gears. The most important investment you can make is in yourself, just like how we are talking about money compounding, skills compound as well. And especially in today's day and age, it is extremely important to have a broader range of skills, right? It's important to be curious and know a little bit of everything, right? That will help you adapt quicker. And career never moves at a linear path, right? Like I studied to be a programmer, but I'm on the business side of a fintech, right? So it's important to have a broader range of skills. And of course, I've written down the few things. I was reading this brilliant book called Balance. You guys, I don't know who the author is, but check out a personal finance book called Balance, where the emphasis is on these 4 different pillars of life. Having enough money, maintaining strong relationships, maximizing your physical and mental health, and living with a sense of purpose, right? So if you have these 4 in place, you're basically living a good life. We all do stupid things, but learn to identify risk. Now, whenever most people think about the markets, they're thinking about how to get the maximum amount of returns, right? But what we need to understand is investing is more of a defensive game than an attacking game. It's more about capital preservation and preserving your capital and then trying to go out there and getting the most efficient kind of returns, right? So it's very important for us to always consider worst case scenario and look things through the lens of risk management. Stop loss in terms of time or money. Now, I was just telling sir as well that whenever, how many of you have a Zerodha account, by the way? All right, awesome. So whenever you guys log in, you see a disclaimer, right, saying 9 out of 10 traders lose money, and on an average, they lose 50,000 rupees, right? So that if you're planning to be a day trader and trade for a living, that kind of tells you what are the odds, right? And the funny thing is that 60% of decisions traders make are all correct, right? So it's funny that 9 out of 10 overwhelmingly traders lose money, but yet majority of the decisions are correct, right? And the reason for this is the way we are wired is we are very risk averse. Say whenever you're trading and you're making a profit, if you're, say for example, you're making a profit of 10,000 rupees, your emotions start getting involved, right? You're immediately very happy with yourself, you're happy to be profitable. Now say that plus 10,000 goes to minus 2,000. Now you're a bit concerned, right? You feel like someone has snatched that profit from you, right? And then that it goes to minus 5,000. And then you start thinking, shit, I should have booked it when I was plus 10,000. Right? And then say it comes back up again, it comes to plus 2,000, plus 5,000, plus 10,000, right? Now you have been on this roller coaster ride and you've had enough. You just want to book that 10,000 and celebrate. You're done with the trade, right? Whereas when it comes to loss, we have like a opposite behavior, right? Whenever we are in a loss, say minus 10,000, you kind of reason with yourself and extend your stop loss, right? Instead of selling at 10,000, you kind of say, no, let it go to, if it goes to minus 15,000, then I will sell it, right? Right? So you extend your stop loss because it will actually cause you physical pain, right? It becomes real when you sell it and accept the loss. So once it goes to minus 15,000, now you reason yourself that I'm already heavily in loss, might as well just keep it around and hopefully it'll turn back, right? You create a false hope for yourself. Now, this is what typically happens to traders is they'll have 6-7 good trades where they make small profits, but they have 2-3 bad trades that will completely destroy their account, right? And this is primarily the reason why overwhelmingly people lose money is because of this reason. So we need to ensure we have risk management strategies in place. This is how even hedge fund managers operate, where they factor in the worst case scenario and they already have an exit plan, right? Make peace with the worst possible outcome. What it does is it allows you to have better clarity and be in a position to make better quality of decisions. Things to avoid would be the debt trap. India's credit burden has never been as high as it is today. I think our credit card spends are double of our debit card spends. And credit cards kind of make it easy for you to buy things impulsively, right? Especially with social media and, you have pretty much all the best minds in the world trying to figure out how to make you buy stuff, how to make you spend time on the apps. And you also have all these cheap loan apps available, right? Which makes it hard, right? But the thing is, credit is can be extremely detrimental to any personal finance plan you have, right? Because credit typically costs you anywhere from 35 to 50% in interest. And once you take a expensive loan and you and credit keeps increasing, then you kind of get stuck where you start taking loans to pay off older loans, etc. That is called like a debt spiral, and too many people fall into that trap, right? So we need to ensure when we use credit frugally, and we are able to pay it back within 25-30 days before the credit gets charged. Paisa double. There are a lot of people, especially when markets are doing well, there are a lot of people out there who are selling you greed, right? Who are trying to tell you how easy it is to make money. I'm sure you all would have seen thumbnails on YouTube on how to become a crorepati in 2 years or 5 years, etc. But there is no real elevator to wealth, right? It's accumulated step by step, right? And market tips, I mean, right? I don't think anyone has watched CNBC market tips and become a crorepati, right? And there are just way too many variables. What best one can have is like an educated guess. And you need to take it as that. You need to take it as a guess rather than a certainty, right? Stay away from unregulated funds, obviously, because if something goes wrong, you don't have any legal recourse. Finfluencers, some of them are really good. They give you valuable information, but a lot of them, as I said, are there to sell greed, to sell their tip service or sell their advisory, and I mean, take that with a pinch of salt, right? About crypto, one thing is never invest in something because it's a trend. If you understand crypto, then and you understand what are the risks involved with it, then by all means invest, but never invest because something is a trend, right? Like a couple of years ago, there was a lot of noise around crypto. A lot of VCs were putting in a lot of money behind local crypto exchanges. But then RBI came out with a regulation around taxation, which made it hard for cryptos to sustain, and a lot of people lost money, right? So if you're not aware of what's really going on around the asset, it's better not to invest. Choose your circle wisely. You pick habits from people you spend time with, right? Subconsciously or consciously, we are always looking at our peer group for what to do, what not to do, right? There's a saying called keeping up with the Jones, which basically means that if your friend gets a new phone, you're thinking whether you need an upgrade, right? Or if your neighbor gets a good car, you're thinking that I need to buy that car or a better car, right? So we are always nudged by people around us. So it's very important for us to pick the right kind of crowd, because invariably we'll pick up habits from them. And habits you pick up early in life tends to stick with you, right? So one habit I hope you guys pick up, if there's one thing you guys take from this talk, is to start investing early, right? As someone much older, I can tell you that it will definitely pay you much more dividends than you can think right now. And it could start as easily as investing 500 rupees in one stock, right? So at least what that will do is that slowly change your trajectory, right? Just because you bought a stock, you might like open Economic Times for the first time and check what that stock is doing, right? So I hope that's one of the habits you guys pick up. 3 habits that have paid me dividends would be prioritizing saving over other things. As I said, pay yourself first, investing regularly, and thirdly, avoiding debt. So I'm pretty much come to a close. If you guys want to know more about investing and finance, we have a free education portal called Varsity, which is currently one of the top, globally one of the top financial resources when it comes to finance in the Indian context. Maybe I'll just open it up. Right, so here you can basically learn, we have different modules, and they're quite explained in a more practical and simple manner, not very textbookish. Just about the markets, basics, technical analysis, fundamental analysis, derivative trading, taxation, risk management, trading systems, etc. And we'll try to figure out how we can, work in maybe collaborating on these things, right? So pretty much done. Thank you for your time. Hopefully this session has been helpful, right? So thanks. If you guys have any questions to ask, we could maybe do that as well. Anything about what we spoke about or Zerodha, I'll also be happy to answer. Hey, hi.
So my doubt is, especially when we talk about financial service, like to sell this financial services, does this company the service? As good or it is very one thing is different from Zerodha, establish.
I can barely actually hear you. It'll be better if you have the mic.
So my question is that when we talk about the financial services especially, like trust is accompanied with the service and it is a bit difficult to sell the service. So you also like at the beginning phase, you also face such kind of difficulties to establish the trust. So what are the things you did to establish the trust in your customers? What were the strategies?
Right,
What were the things
right.
that you did?
Cool. If someone can pass the mic back. So initially when we started Zerodha, we had absolutely zero credibility. People thought that we were doing a scam. We thought that our charges were too good to be true. So what we were doing that time is very basic. We were part of all these online forums, and we used to do what they call as black hat operations, where we kind of, I had multiple IDs and I'm talking about, hey, have you heard of this company called Zerodha, So that's kind of like self-advertising and being part of those trader communities and trying to talk about it, etc. What really helped us take off was, I think, in 2011, Economic Times article covered us, which spoke about this company in Zerodha charging 20 rupees per order. So then after that, every phone call, I would be telling our clients, have you read Economic Times? This is what the company, this is what they had to say about us, right? But I think what has really helped us is our business philosophy has always been to do right by the customer. Being in finance industry, there's a lot of things can be shady, right? People, they exaggerate the kind of investment returns they can give. There's so much that can go wrong. So one thing very wisely Nitin did was not provide any advisory service, and just keep it as a platform where people, just be an execution platform basically. And generally the way we conduct ourselves, right? Because being head of sales at that time, not even head of sales, I remember going to Nitin with a lot of different propositions on partnerships that could be quite lucrative, right? And he's turned down 99.9% of them, right? And I could not understand someone who's running a business, how they can take that call when there's so much money on the table, right? But now where we are, I can definitely understand his vision. So if, I know it's cliche to say do right by the customer, and it's usually everybody's tagline, but when you actually do it and you give it a higher priority than your own profits, then definitely the marketplace will reward you for it, right? Because especially a business around finance is built on trust, right? Built on trust and credibility. Like I was just telling you guys about FinShots, right? They're doing extremely well with their Ditto advisory because of all the goodwill they built up with FinShots, right? And now As I said, they don't do any kind of push sales. So I think, what really helps is if you keep your customer at the core and you listen to them, listen to their feedback, that will definitely help your business grow. Yeah, hey. Yeah, someone can.
Hello, sir.
Hey.
Sir, why Zerodha don't want to spend on marketing or advertisement? Is it difficult for the sales team?
Right, if you can. So I have a running joke with Nitin from the past 10 years, okay? So 10 years ago, once Nitin said that this is the amount of profit we made this year. So I was like, oh, so we can get Katrina Kaif to endorse us, right? So even now till this day and age, I'm saying, dude, Katrina Kaif is married now, why aren't we doing anything, right? So the whole premise has been that usually the way our business is that you don't wake up one day and say that I'm going to invest. Typically, you are introduced to investing through a peer, through a friend, through a family member, and then you go about your journey, right? And so we didn't want to burn money just on, just spraying advertising all over the place. Maybe, you're watching something else and you're not really interested in that. And also, we didn't want to get into this game of who burns more money, right? Like for example, if I'm running a Italy shop, right? I'm running a famous Italy shop known for its quality. Now another shop opens next to me. Now that guy needs to compete with me, so he's going to offer Italy and free gulab jamun, right? Now I don't want to get into a war where I'm now giving Italy and 2 jamuns, right? So we don't want to get into escalating advertising war, so to speak, right? The entire idea has been that let the serious crowd come to us, right? So we keep our products at the core of it, where we are constantly working on our products and our offerings, and people who are serious about their money will eventually come to us anyways, right? So that's how we look at things. Anyone else? Cool, so thanks again guys, thank you. I remove this now?
Thank you, Mr. Salman, for gracing us with your presence and enlightening us with your wisdom and educating us about the financial sector. Now, I request Mr. Jayanta Chakrabarti, Dean of Academics, to present the token of thanks to Mr. Salman.